Let's take a look at the Treasury market right now as we continue with our look at the major markets for 2021. We're going to look at Treasury notes and yields. I'm going to start out by looking at the yields market because this is such an informative chart. I've made a case that the near 40-year bear market for the bonds, the bull market, or 40-year bear market for yields is over. And that when we saw the panic, when we saw the yields get under 40 basis points, that was it. We're not going to see that again. There is no way that we're going to see Powell go to negative interest rates. He knows the destruction that causes, and he has said it numerous times. So even in the worst of crises, we're not going to see that, and the likelihood of us seeing 40 basis points again, I think, is very, very small. We're going to switch over from the gold market here to TNX. This is a phenomenal chart. Talk about perfect cyclical rhythms. You can see that. I want you to note the green phases in there. Those are the rising phases for interest rates. And if you look at these cycle harmonics in here, you have a dominant cycle, as you see right over here, and you have the minor cycle. And you can see how the minor cycle shows up within the dominant cycle, the two halves. So it's a minor half cycle and a full dominant cycle. After you get the nesting right over here, where they're both coming down, in other words, yields declining right into the expected low time frame, you get a rally after that in yields or decline in bonds. Each of those rising phases have lasted between 6 and 28 months and have retraced at least 50%. Now I'm going all the way back here to 1997, so we're looking at about 23 years right here. This is just phenomenal. You can see all of these green zones bringing big upticks in yields, at least to 50%. Look where we are right now. What that says to me is that it is extremely likely that we're going to project to 1.5 to 1.9%, 1.9% or more is reasonable in my opinion, into this coming 2021 and maybe even into 2022 when we look at this. It depends on how long this rally phases. Again, they are between 6 and 24 months. And let's just go back out over here so you could see 6 and 28 months, with retracing up at least 50% of the decline. So that would mean that we're going to get probably up to that 50% retracement that you see right there, and that would be taking you up to the area of about 1.9%. Well, what does that translate to in the futures? I'll show you that in a second. Look at these harmonics. Look at the gorgeous cycles that are in here, and it tells you that we are in a period of rising interest rates right now. Now, the stock market can stand that for a while, but if interest rates start to spike, which could happen at the slightest hint that the Fed is done or that COVID-19 is going to be solved, the vaccines are going to work, the reality of what the valuations of the stock market is. Now, there are a multitude of things that could push these yields up very high. And if you go back again and look at 2018, the potential of them being able to raise interest rates just disappeared very, very quickly. They were trying to raise interest rates right here. And of course, we got into this repo crisis, and it shows you what bad shape our economy is in without all this funny money printing going on. So I have declared that the 40-year bear market in yields is over. And you can see I have noted that right over there. And that we are going to start moving up pretty significantly in yields. So we're projecting a 1.9% yield likely coming in 2021, and maybe it takes out until 2022. And I got to tell you, it could be higher than that. Remember, it's at least 50% upward retracements that you've seen there, and some of them have been 78.6%. So that is a likelihood that we're going to see yields moving up. So how does this translate into the cyclical action that we see in the 10-year note market? Here is the 10-year note market that we see right over here. We'll let you see the amazing cyclicality in here also, and an important thing that's going on right now. You can see those two yellow areas I've highlighted, and I'll explain that to you. So this is 10-year notes, and the average length increased from about 16 months, as you can see right over here, to it beginning to lengthen out, 18, 19, 19 right over there, and then a 20-month right over there. So we're getting a little longer cycles. It's averaging now getting close to about 20 months. Now, the rally phase, the low that was due to occur right over here, came on 20 months, and then you got a rally that only lasted a couple of months and it started to come down. That's like what happened right over here. And you can see that we believe that we're going to start to get a decline in the bond market that looks like that. You're going to need to get a break underneath that cycle low support, 136.22, which would be very negative. That's that line that you see right over there. And once that happens, it will confirm the bear market in bonds that we are looking for, and a very, very significant decline coming. Now remember, I talked to you about 1.5 to 1.9% yields coming likely in 2021. Well, based on the way this cycle shapes up, it says that this market is likely to decline right through the end of the year, 2021. Here is your 1.46% yield at about 131.23. So that would be about a 7-point drop in the ZNs. That's huge. 1.9% takes you down to about 129, which we think is a likelihood. So you can imagine how that extrapolates out into the, I think, better trader of the 30-year bond market, or 30-year bonds when you look at that. So for the year this last year, bonds were up 8.7%. Yields lost 1.75%. To close the year around 93 basis points. Pretty big drop in yields in this big rally right over here engineered by the Fed. Of course, by a very, very slow economy. 2021 cyclical projections are for a high in the first quarter. So the high actually might come in January. I mean, very soon. We're not exactly sure, though. If we get the stock market decline that we expect into late February, early March, that's probably when you're going to get the high for the year in the bond market. The expected range is 139, 129. Now we're at 138.10 right now, so you can see we're not looking for much on the upside and then moving down. 10-year yield range we think would be down to close to 80 in March, and then 80 basis points, and then moving up to 1.9%. End the year near the low, and the bear bond market confirmed, as you could see that we have right over there, if we get a break underneath that 136.22 area. If it gets under there, you could expect a free fall, a big increase in yields, and a likely stock market drop that would accompany that panic. That's what we think is likely to happen, with yields moving up and leading the stock market down, which is not how it's been. Usually it's been the bond market moving up when the stock market declines. Well, we think we'll see that in March, but overall we think we'll see the yield market moving very much to the upside, and the bond market moving to the downside. So you can see the cyclical rhythms in here just absolutely perfectly clear when we look at that. So that is our projection for the Treasury notes and yields for 2021.